Hello, everyone, and welcome back to the Advanced Financial Management learning session. Today, we continue with the topic Real Estate Finance, and we are in this lesson going to learn how to value real estate, what we call real estate valuation, which is also known as property valuation or land valuation. And in this lesson, we will introduce the real estate valuation. We will be looking at the three main approaches that can be used to value property, which are the cost approach, the income approach, and the sales comparison approach. We'll be taking each approach one at a time, and at the end of every approach, we'll work out a practical or an illustrative example on how to value property. And candidates, the real estate valuation is a process of determining the estimated worth of a specific real at a particular point in time. It is essentially an opinion of value, typically the market value, which is the price a willing buyer would pay and a willing seller would accept under normal market conditions. And in simpler terms, estate valuation answers the question, what is the value or what this property is likely worth right now? It could be a building, an industrial park, it could be a garage, it could be any real asset or property. So that is the meaning of real estate valuation. And real estate valuation process is critical for various stakeholders in the real estate market, including buyers, sellers, lenders, investors, the tax authorities, insurance companies, legal entities, and so on. So this process is crucial, it's critical. For example, for buyers, it is critical for buyers to determine a fair offer price. It may be critical for sellers to set a competitive listing price. It is critical for lenders to assess the collateral for mortgage loans. It may also be critical for investors to analyze potential returns on investment. It is critical for insurance companies to determine coverage amounts. The government may also find this process critical in order to calculate property taxes. Legal entities may also need to do what we call estate settlements. All right. So real estate valuation is critical, and there are various methods that appraisers or valuers can use in the process of determining the estimated worth of a specific real property at a particular point in time. And real estate valuation candidates is typically conducted by licensed professionals who are called appraisers or valuers, and I've said they use various methods. They use various techniques to arrive at the opinion of value, In this lesson, we begin by analyzing the first approach, which is the income approach. There are three approaches. Three approaches of valuing real estate. One is the income approach. The second approach is the sales comparison approach. Sales comparison approach. All right. There are three approaches, candidates, of valuing real estate. The first approach is the income approach. The second approach is the sales comparison approach. And the third approach is the cost approach. So there are three main approaches that appraisers can use in the process of valuing real estate. The first one is income approach. So we begin by analyzing the income approach. The income approach. The income approach. Now, the income approach estimates property value based on its ability to generate income. All right? A property here is valued on its ability to generate income, on its ability. It's based on its ability to generate income, which makes it the primary method for valuing commercial land, rentals, investment properties, and so on. The ability to do what? To generate income. A property here is valued, I repeat, on its ability to generate income. And the key concepts here are the net operating income. All right? The net operating income, let me put it down. When valuing real estate using the income approach, we have the net operating income, which is one of the key concepts. The net operating income. The net operating income. This is the property's annual income after deducting operating expenses and so on. So the net operating income would be equal to the gross income, the gross rental income, minus the vacancy loss. Let me put it down. This is equal to the gross income minus vacancy loss minus operating expenses. So the net operating income is equal to the gross income, the gross rental income, the gross rental income. Okay? We deduct the vacancy loss. We deduct vacancy loss. What is a vacancy loss? Now, vacancy loss refers to the lost rental income. It refers to the lost rental income when property is unoccupied. And that could be due to lack of tenants or due to market conditions. Determining net operating income, we deduct vacancy loss and operating expenses from the gross rental income. So that's the first key concept when valuing real estate using the income approach. The second one is capitalization rate, popularly known as the cap rate. The cap rate. Now, when valuing real estate candidates, we have what we call the capitalization rate. The capitalization rate. Now, this is the expected rate of return based on market sales of similar properties. You understand? Capitalization rate is the expected rate of return based on market sales of similar properties, which is equal to NIO over property value. Capitalization rate is equal to the net operating income over the property value. That is the capitalization rate, which we've defined as the expected rate of return based on market sales of similar property. The third concept here is the discount rate. The discounting rate. the discounting rate or the discount rate. Now, the discount rate is used in the discounted cash flow analysis, because what we'll be seeing that under the income approach, there are two main approaches. There are two main approaches. When using the income approach, there are two approaches. One is the discounted cash flow analysis approach. Then we have the what we call the direct capitalization method. There are two methods. When using the income approach, there are two methods. There are two methods. There are two methods here. Two methods. There are two methods. Methods. One is direct capitalization. Direct capitalization. Then number two is the discounted cash flow analysis method. The discounted cash flow analysis method. When using the income approach, there are two methods. One is the direct capitalization and the discounted cash flow method. You understand? So when valuing property using the discounted cash flow method, there is the concept. There is this discounting rate, the discount rate, which is our third concept, the discount rate. The discount rate is used in discounted cash flow analysis, which reflects the investor's required rate of return. The required return. It reflects the required return, and it accounts for risk and the time value of money. It accounts for risk and time value of money. It accounts for risk and time value of money. The discounting rate accounts for risk and the time value of money. The time value of money. So as I've said, there are two methods. Now these are very important concepts when valuing real estate using the income approach, which is one of the three basic approaches. Now let's move on to the methods, the direct capitalization method and the discounted cash flow method. The discounted cash flow method. Now, candidates, the direct capitalization method is simple. All right? The direct capitalization method. There is a formula for direct capitalization method. Direct capitalization method. When using this method to value property, the formula is simple. The formula here is simple. Okay? The value will be just the value of, let me put it down, value of property will be equal to the net operating income we divide by the capitalization rate. That is how to determine value of property using the direct capitalization method. Now for the discounted method, the DCF, discounted cash flow method, what is the formula? Now for the discounted cash flow method, the discounted cash flow method, there are a few steps to follow. First of all, the valuer has to get the forecast future cash flows. Forecast future cash flows. Here, first of all, one is to forecast future cash flows. The future cash flows expected to be generated from the property is to be forecasted. Get a forecast of future cash flow for say 5 years or 10 years. Then we estimate, number 2, estimate what we call the terminal cash flows from the property. Estimate terminal cash flows, which could be the resale value at the end of the holding period, and so on. Then C, discount the cash flows. So there are two main cash flows here: the forecasted future cash flows and the cash flows expected to be generated from the terminal value of the property. Two things. Then discount these two cash flows. You understand? So we discount. The third step is to discount the cash flows to the present value using a discount rate, which we said here accounts for risk and time value of money. You get the present value of these two cash flows using the normal formula for discounting. So here, candidates, the value then of property will be equal to the summation of the cash flows. Okay? We get the summation of the forecasted cash flows. So we'll have the cash flows. We're going to have the cash flows. We get the present value 1 plus R raised to T or N. So this represents the first category of cash flows, the future cash flows. So these future cash flows are discounted at a discounting rate, and we indicate the period. It could be 5 years or 10 years. Then we add the present value of the terminal cash flow. The terminal cash flow. The present value, we get the present value of the terminal cash flow. So we'll get the terminal value we discount it at 1 plus R raised to T or N, where N is the holding period. You understand? CFT is the cash flows, the future cash flows after estimating or forecasting the future cash flows that are expected to be generated from the project or property. We then discount them at a discounting rate. Then we add the present value of the terminal value. And how do we get the present value of the terminal value? We discount the terminal value by dividing the terminal value by 1 plus R raised to N. So this is the formula for calculating the value of property using the discounted cash flow method. There are two main methods. Okay, and shortly we'll be working out illustrations on the same. But before we get into the practical or illustrative example, we want to discuss shortly when to use the income approach. When do valuers or appraisers use the income approach? You understand? Now, because candidates, the income approach to property valuation could be appropriate under certain conditions. Okay? The income approach to property valuation, I repeat, is most appropriate and should be used primarily when valuing the income producing properties. When valuing income producing properties. And these are properties that are purchased with the expectation of generating revenue. So we need to answer the question, when? When to use income approach to value property. When? Now, I've said there are ideal scenarios for using the income approach. One is commercial properties. When valuing commercial properties, then the income approach is the most appropriate. This is the most common application. Examples of the commercial properties would include the office buildings, rental centers, shopping malls, apartment complexes, industrial warehouses. We have hotels, motels, restaurants, a parking garage, self-storage facilities, and so on. Those are commercial properties. If you want to value such properties, then we use the income approach. It is most appropriate and should be used primarily when valuing income producing properties like rentals and so on. So that's the first scenario that will necessitate the use of income approach. Now, the second scenario is investment properties. Investment properties. When valuing investment properties, any property acquired for its potential to generate rental income or other forms of revenue, that's what we are referring to as investment properties. 3, we have properties with established income streams. Properties with established revenue or income streams. Such properties should be valued using the income approach. Properties with established revenue streams. Now, when a property has a history of generating consistent and measurable income, then this approach can be reliably applied. Number 4, when investor perspective, this will be used when investor perspective is key. The income approach can be used when investor perspective is key. The income approach directly reflects how investors analyze and value properties based on their financial returns. So when investor perspective is key, then we use the income approach to value property. 5, it may also be used in conjunction with other approaches. The income approach should also be used in conjunction with other approaches. Now, for certain commercial properties, the income approach may be used in conjunction with the cost approach or the sales comparison approach in order to provide a more comprehensive valuation. So we've answered the question when to use the income approach in valuing property. One scenario is when valuing commercial properties, when valuing investment properties, when valuing properties with established revenue streams, when number 4, investor perspective is key, and again when it can be used to value property in conjunction with other approaches. The other approaches could be the cost approach or the sales comparison approach. And it should be noted, candidates, that there are situations where the income approach may be less suitable or may require caution. For example, when valuing the owner-occupied residential properties, like the single-family homes or that are purchased for personal use, such property may not be valued using the income approach. The income approach is not the primary motivation. Okay, income generation, in other words, may not be the primary motivation for such properties, the owner occupied properties. Another case could be properties with no established income history, or special purpose properties like churches, schools, and so on. Such properties may not be suitable to be valued using the income approach. Again, we also have unstable or highly volatile markets. In rapidly changing markets, historical income and expense data may not be a reliable indicator of future cash flows or future performance. Okay? So those are situations when this income may not be used. Let's move on to discuss briefly the limitations of this, using this approach. Limitations. What are the limitations? Now, the first obvious limitation of the income approach is reliance on projections. Let me say assumptions and projections. You recall we noted here in the discounted cash flow method, we first of all forecast future cash flows. So relying on future cash flows has its own limitation, because the accuracy of the income approach heavily depends on the reliability of income and expense projections, as well as the selection of an appropriate capitalization rate or even the discounting rate. And that involves assumptions about future market conditions, which can be uncertain. So that's one limitation. Now, the second limitation is that this approach depends on data. Data dependency. Accurate and reliable data on income, expenses, and even the capitalization rates are crucial. And in markets with the limited transaction data or poor record keeping, obtaining such information can be a challenge. 3, complexity. From the word complex. The income approach can be more complex than the sales comparison or even the cost approaches, which requires a thorough understanding of financial concepts and market analysis. 4, is not suitable for all properties. Recall we mentioned some properties which may not be valued using this approach, like the owner, single owner properties, we have the special properties, and so on. It is generally not appropriate for non-income producing properties like the owner-occupied residences or even the special purpose properties, where income data may not be relevant or even readily available. So that's the fourth challenge. It's not suitable for all properties. We mentioned the properties that may be valued using this approach, just the commercial properties, the investment properties, the properties with established revenue streams, and so on. Now, the fifth limitation is that this method is sensitive to small changes. Sensitivity to small change, for instance, in the cap rate, can significantly alter or change the value of property. Small variations in capitalization rate or even operating expenses or even income projections can lead to significant differences in the final valuation. 6, we know how difficult it is future trends. Difficulty in estimating future trends. That is a drawback. Accurately predicting future rental rates, the vacancy rates, and even the operating expenses can be difficult, especially in a volatile market. There is also potential for manipulation. Potential for manipulation. The income and even the expense data can sometimes be manipulated, requiring careful due diligence and verification. So there are many limitations that are associated with the income approach to valuation of property. Is that clear, candidates? Yeah, we are discussing real estate finance and more specifically valuation of property. Say there are three approaches. The income approach. We began by studying the income approach, which we said has two methods. There are two methods when valuing property using the income approach. First method is the direct capitalization method and the discounted cash flow method. We've given the formula for direct capitalization method is equal to the value of property will be equal to the net operating income divided by the capitalization rate. When using the discounted cash flow method, the formula is given here. We get the summation of the estimated cash flows and the terminal value of the property. We've gone ahead to discuss the scenarios when to use the income approach. We've said that commercial properties can be valued using this approach. Investment properties, properties with established revenue streams. When investment perspective is key, this approach may also be used in conjunction with the other approaches, which are the cost approach and the sales comparison approach. We also mentioned scenarios when this approach may not be appropriate. We've gone further to discuss the limitations of the income approach. We say that this approach relies heavily on assumptions and projections, which comes with its own challenge. There is data dependency, complexity. It's not suitable for all properties. It's also sensitive to small changes. It's difficult to there's difficulty in estimating future trends and potential for manipulation. There could be more other limitations like not reflecting the intangible factors. Okay, this method may not again reflect intangible factors. The income approach primarily focuses on financial returns and may not fully account for intangible factors that can influence property value, such as the prestige, emotional attachment. These are non-financial factors, all right? The unique architectural features of property, and so on. This approach does not capture such factors, and that is again one of the limitations. Now, it's now time to work out an illustrative example. Going to work out an illustrative example. So allow me to do away with this part of board. The income approach. We are going to illustrate the two methods. One is the direct capitalization method and the discounted cash flow method. So we begin with the direct capitalization method illustration. Direct capitalization method. Here is the illustration. Consider a small apartment building with the following characteristics. Number 1, potential gross income. Number 2, vacancy and credit losses. Number 3, operating expenses. Number 4, capitalization rate. Consider, I repeat, a small apartment building with the following characteristics. The potential gross income. Now that is the building has 4 units and each unit rents for 50,000 Kenya shillings per month. Number 2, the vacancy and credit loss. Assume a 5% vacancy and credit loss rate. Number 3, operating expenses of 900,000 shillings. Number 4, the cap rate of 8% required. Calculate property value using direct capitalization. Calculate property value using direct capitalization. Now, the first feature here, candidates, is the potential gross income. Now, the potential gross income here is the total potential rental income if all the units were occupied. Then the second feature is the vacancy and credit losses. Now, vacancy loss or credit loss accounts for the periods when units are vacant or when the tenants don't pay. And here we are told that the rate is 5%. So that's the meaning of operating expenses. I mean the vacancy and credit losses. Then we have to assume the operating expenses of 900,000 shillings. We have the capitalization rate of 8%. Now, the operating expenses, candidates, are the costs associated with running the property. It could be the property taxes, the insurance, maintaining the property management fees, and so on. That is what we refer to as the operating expenses. They are the costs that are associated with running the property or managing the property. So we are to calculate the value of this apartment. This is an apartment building using the direct capitalization method. And the formula is given there. Value of this property will be equal to the net operating income we divide by the capitalization rate. So first of all, we have to determine the net operating income. The net operating income. First of all, we will have some workings here. We are given, first of all, the potential gross income. The potential gross income. What is the potential gross income? Before calculating the net operating income, we need to determine the potential gross income. The potential gross income and the effective gross income. We have the potential gross income, candidates. We read from the question that the building has 4 units and each unit rents for 50,000 shillings per month. 50,000 shillings per month. 50,000 shillings per month. So per year, this will be equal to 4 units times 50,000 shillings times 12. This will give us the potential gross income. It may not be necessarily the effective gross income because we have the vacancy loss. So how much is that? 1 unit. This is 4 units times 50,000. That will be for 1 month. We multiply by 12. So I'm getting here 2.4 million. That is the potential gross income. Potential gross income is 2.4 million. But we have, again, candidates, the vacancy loss. The vacancy loss from the information given is 5%. We are told to assume 5% vacancy and credit loss. 5% vacancy and credit loss. We have the potential. This apartment building has the potential of generating 2.4 million, but due to the vacancy loss, which is 5%, 5% times 2.4 million. That will give us the vacancy loss. So we multiply this by 5%. This is equal to 120,000. 120,000 shillings is the vacancy loss. Now, out of this, we can then determine the effective. We are going to determine the effective gross income. Effective gross income. Now, what do I mean by effective gross income? Now, the effective gross income, candidates, is the actual income expected after deducting for vacancies and losses. And this will be equal to the potential gross income minus the vacancy loss. The potential gross income is 2.4 million. The potential loss is 120,000. Though this building has the potential of generating 2.4 million per annum, there is the vacancy loss of 5% of that amount, which is 120,000 shillings. Now, when the 120,000 shillings is the vacancy loss, and we define the vacancy loss as the periods when units are not sold or when vacants don't pay. So the difference will be the effective gross income, which we have defined as the actual income expected after accounting for the vacancy loss. So 2.4 million deduct 120,000. So the income reduces to 880, yes, 2,280,000 is the effective income. That is the effective income. So with this, we can then calculate the net operating income. Working number 4, net operating income. How do we determine the net operating income? The net operating income will then be equal to the effective gross income. We deduct operating expenses. It is the income remaining after deducting operating expenses from the effective gross income, and the operating expenses, this will be equal to the effective gross income minus operating expenses. The effective gross income is 2,280,000. Operating expenses 900,000. The difference is the net operating income. the net operating income minus 900 is equal to 1,380,000 is the net operating income. So that's the working for the net operating income, which is equal to 1,380,000 divide the capitalization rate. What is the capitalization rate? The capitalization rate given in the question is 8%. Converted into decimal is 0.08. So we divide by the cap rate of 0.08. With that, we'll have the value of this apartment building. So we divide 1380 by 0.08. So what is the value here? The value of this building is 17,250,000. So that is how to calculate value of a property using the direct capitalization method. The direct capitalization method. This is how to calculate the value of a property using the direct capitalization method. You understand? Yes. That is clear. That is clear. That one is clear. Can we move on to the next method? The discounted cash flow method. Discounted cash flow method. We've done the direct capitalization method. We are now moving on to the discounted cash flow. The discounted cash flow method, which we said is a summation of the present value of future cash flows and the present value of the terminal cash flow. Two things. Now let's have an illustration. Illustrative example of the income approach using the discounted cash flow analysis method. Consider a small commercial building with the following projected cash flows over the next 5 years. Number one, the net operating income is 1.5 million. The annual net operating growth rate is 3% per year. Discounting rate, which is the required rate of return, is 10%, which reflects the risk of the investment. And the terminal value at the end of the 5th year is 17,166,667. That is the characteristics of this commercial building. You are given 3 variables: the net operating income, the annual net operating growth rate, the discounting rate, and the terminal value. So we are required to calculate the value of the commercial building using the discounted cash flow method. Using the discounting cash flow method. That is the question. So we can have the solution. Candidates will remember what we said, that the discounted cash flow method, the formula is equal to the summation of the present value of cash flows and the present value of terminal value. The present value of the terminal value. So the value will be equal to the summation of the cash flows, the present value of the cash flows. How do you get the present value of cash flows? By discounting the cash flows. So we discount the cash flows by dividing the cash flows by 1 plus r raised to t. Then we add the present value of the terminal value, which is equal to terminal value over 1 plus r raised to the holding period. So these are two things. So the rest is just working. You're going to have workings. Workings. Now look at the question again. The net operating income for year 1 at the end of year 1, that is at the beginning, ending year 1. Ending year 1 will be 1.5 million. So we need to grow this income. We need to grow this income for 5 years. So we need to grow the income. At the end of each year, what will be the ending net operating income? It is growing at the rate of 3%. Do you see that? So that will be the process of estimating the future cash flows. These future cash flows, we will grow the cash flows at the end of every year, then we discount. The terminal cash flow is also given, we will discount it. So there are various ways of doing it. We'll have a working. So let's have, do we need a table to do this? Yes, you can have a table. Let's have workings. Let's take it step by step. Look at the question again. Let's have a column for the years. Then beginning net operating income. Year 1, there is no net operating income at the beginning. Then we have ending. You can have a column for ending net operating income. Do you see that? Because we need to grow this income by 3%. Then of course we can have the discounting rate or factor. Let me just call it present value. Let me call it present value income. Because these incomes are not annuities, cash flow. Present value interest factor 10% N. So these are the discounting factors. So first of all, we have the years, then we have the beginning NOI, we have the ending NOI, the present value interest factors, then we'll have the present values. How do we get the present values? We multiply the ending net operating income by the present value interest factor. That will give us the present values. So that these are important columns. So at the beginning of year 1, the cash flow is 0. At the ending of year 1, the cash flow is 1.5 million. So this 1.5 million becomes the beginning net operating income or cash flows at the start of year 2. This will be 1.5 million at the start of year 2. Now at the end of year 2, this income is going to grow at the rate of 3%. So we're going to multiply 1.5 million. This is year 2. Year 2 will be, this is going to be 1.5 million times 1.03. So how much is it? Let me check my machine. It's 1.5 million times 1.03. It is going to grow at the end 1545. This 1545 at the start of year 3 will be 1545. Year 3 again is going to grow from 1545. We multiply by 1.03 times 1.03. It has grown to 1591,530. The ending cash flow at the end of year 2 becomes the beginning cash flow. Year 4, 1591,530. Year 4, again, the 1591,530 will grow by 1.03. That is 3%. You multiply that figure by 1.03. It has grown to 1639,091. That is the ending cash flow. Year 4 becomes the beginning cash flow. Year 5, 1639,091. Year 5 cash flow is 1639,091. 1639,091. 1639,091 times 1.03. This is equal to 1688 264. 264. Yes. So these are the future cash flows. The future cash flows. These are the future cash flows candidates after growing the cash flows at the rate of 3%. At the end of year 1, we have it, year 2, year 3, year 4, year 5. So these are the cash flows which we now ought to discount at what rate? Do you have this discounting rate? Yeah, the discounting rate is 10%. Now these factors we read from the tables. We are going to read these factors from the present value interest factor table. 10% 1 year is 90.91. This is 0, 90.91. Year 2, I'm reading from the tables, 0.8, 82.64. Next 0.75, 13. Next 0.6, 8, 30. Then year 5, 0.6209. So these are the cash flows for the 5 years. Then you have the terminal value as read from the question. Year 5, another value there. Cash flow is 17,166,6. Year 5. Year 5, 17. Reading from the question, 166, 667. All right, 667. In fact, I ought to have written it here. 17, 166, 667. The present value interest factor will be 0.6209. So we multiply the cash flows by the present value factors to get the values. So year 1 will be 1.5 million times 0.9091. This is equal to 1363,636. Next, we multiply 1545,000 times 0.8264. This is equal to 1276,788. Next, 1591,530 times 0.7513. This is equal to 1195,518. Next, we have 1639,091 times 0.6830. This is equal to 111,9420. Year 5, we discount 1688,264 by multiplying it by 0.62909. 6209 year 5, 6209 year 5, year 5. This is year 5, the 5th year. 6209. So I'm getting here 11, 15, 48, 287. Then lastly, we discount the terminal value. The terminal value will be equal to 10, 65, 8890. So these are the present values. So we get the summation, the sum, the total. We are going to add all these present values to get the value of this property. To get the value of the property. Get the value of the property. To get the value. So the total present values will be equal to 16,662,339. 16,662,339 shillings is the value of this property. Is the value of this property. The value of this property. This is equal to 16,662,339. There are two elements. The future cash flows we grew by 3%, and the terminal value which you have discounted here at the end of the holding period. That is how to calculate the value of property using the discounted cash flow method. We've done an illustration on the same. In this lesson, candidates, we've been discussing the approaches that can be used in valuing property, and we said there are three approaches: the income approach, the cost approach, and the sales comparison approach. In this lesson, we narrowed down to the income approach. In our next session, we're going to learn how to calculate the value of property using the cost approach. Thank you. God bless you. Bye-bye.